Thank you for joining our episode 3 of this Making the Turn webinar series. This is an AMA. We're doing something a little bit different here. Instead of jumping right into an AMA, what we've done is between John and I, we've got a fair bit of prop trading, actual prop, in-house prop trading experience, and we've created this personality. A guy named Earl E. Bird, and Earl E. Bird had attempted to join a prop shop, and we walk you through the process. And we're in the third part of his development as a prop trader. We'll go over that scenario very briefly, and then we'll jump right into the questions. I want to remind you that derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So here we are. Our focus for today, very simply, just what I covered here. We've done episode 1 and 2. Today is episode 3. Thank you for joining us. Episode 1, it's the tryout. Early Bird was a new hire, squeaked into securing a position in this prestigious prop shop, and was able to get a seat. And the last time we met, he was a trainee trader. And we walked you to the point where he had kind of been struggling, but following a program, and is somewhat stable with his losses. To watch the first episode and the second episode, please point your browser to go2ct.pro, MTTAMA number 1, and MTTAMA number 2. And you have those links. You have those links in your chat box in Zoom right now if you want to click on those and bookmark them or save them. Of course, we're doing Junior Trader now. They've made the cut. How do we now develop as a trader? And then on May 28th, we're going to be talking. We're going to be coming back and following Earl as he makes it to Senior Trader. What does Earl have to do to manage consistency and growth? Basically, at this point, he's a stage 4 trader and is managing growth at that point. All right. So Early Bird, where we left last time, we were, the last thing we talked about was days 36 to 60 of his tenure with this prop shop. We said he kept showing up every day, following the plan, and things are moving along, some good, some bad. He's hanging in there with a break-even overall performance. In the trader world, this is an outstanding outcome after 3 months, which is 60 days of live trading. The more he trades, the more experience he gets, and the less he has to think about his setups. The goal is to get to the point where they just happen, right? Setups just kind of happen. It shows up, your fingers do the work, and you don't think too much about it. Once that is firmly in place, we become a junior trader. So now we're at day 61. So on our 4th month, beginning of our 4th month, day 61 to 180, which is a lot, 9 months. So 4 to 9 months. Generally, when I ran a prop shop, it was a different style of trading, but the expectation is that there's a dip in people's accounts, losses, costs accumulate. By the 9th month, we're kind of on our way to seeing a break-even point in the equity in our equity curve. So that's where we're going to end up today with this junior trader as Earl gets through his development. So at this point on the 61st day, he's struggling to punch in and punch out, given that things are happening that make him feel stuck. He's kind of seeing the same thing over and over. Good days, several good days, a bad day wiping out a couple of good days, and so on. He's making the same mistakes. The markets are sometimes kind, sometimes they aren't. P&L isn't going anywhere, right? It's pretty flat, covering losses, covering costs. Seeing other people in his group getting called out or warned because they're no longer showing any promise. At this point, when you're 3 months in, you really know who's going to make it and who isn't. Most prop shops, you hire slow, fire fast. And so Earl is starting to see that his desk is there. A couple of guys have been pulled off or have been warned. He's trying out a few things that kind of shakes you up. It tells you that there's a time limit. It's needed sometimes to create some accountability. And he's trying out a few things and talking to people, but with every change he's making, he gets an injection of hope. Oh, that's how I should do it. That should work. And then things kind of don't work after a while. So this is a typical part of the development process. You go and talk to someone who you think is making money in the group, and they tell you, oh yeah, I'm using this indicator and I'm doing this, this, and that. And you're like, oh yeah, that totally works. I can see how that works on the chart. You can spend the whole evening going bar by bar and seeing how it works. But then you go to apply it in real time and it generally doesn't work. So with finances getting squeezed and time running out, Earl has to hunker down and get his process working properly and to execute it without fail. That's what makes money. Just get your process down pat and just execute on your setups. He's getting some clear experience of what it really takes. He's seeing others around him performing well by sticking to their process, following their discipline, and focusing on mastering specific setups. So that's beginning of month 4 through month 9. Earl, so month 9 is upon us, and it's 181 days now, trading days. He's gotten some experience under his belt. Earl has held steady. He continues to show promise. His P&L isn't growing rapidly, but it is starting to turn up. Earl's now deeply negative in his account, given his desk fees, software fees, terminal fees, losses, etc. However, he's chiseling away pretty well. Earl has his best day following the market breaking out of balance and running for a bit. He has finally experienced what a solidly executed trading plan feels like. So he's finally had that one really good trade. I remember the day this happened to me. And I can tell you it changes things, right? You become a believer because it's happened to you. So he finally had that well executed plan day. Everything worked. He could almost predict what was going to happen. He's on it. And this event is key for him as he will seek to replicate this. His job is to just replicate that exact kind of circumstance. Earl's seeing pops more and more, and he finds himself more often in the flow of the market. This in turn translates to good expectancy and strong days, strong outcomes. Earl's refining his plan a bit more and is only focusing on A+ setups. His charts, his execution platform, and his daily routine are dialed in, and he's not changing things. He's just focusing on execution. Okay. This is where hopefully the returns start showing up, and they start showing up rapidly. This is the typical pattern for a prop trader. Earl, what we're describing with this hypothetical person is what I've seen probably 36 or 38 times in real life with my own prop traders, as well as others that I coached while I was being a prop trader working for someone else. So this is what we've shared with you so far. From here, Earl's focus will be on maintaining stringent risk controls while growing his size. His clip size will present some new challenges, but the process is the same. We'll talk about increasing his clip size and the growth process on the next episode. How do you increase your clip size properly? How do you cut back properly as you grow and you run through rough patches and things like that? A couple of announcements for you we want to make sure you know about. We do have cohort 5 of the accelerator program running. John and I run that program at Convergent. The accelerator program, very briefly, it is the flagship program that is intended to take people from wherever they are through, from the very beginning through the entire process of understanding how the market works and creating a plan to become a professional trader. That's the goal of the accelerator program. This is the program we will put our own prop traders through, early bird, through, in order to be backed. Registration will close at the end of today. We had our welcome session today. I think module 3 will drop on Friday, and our first coaching session is this Friday. So today is the last call. If you are thinking of joining the accelerator program, which includes 6 months of Convergent membership, I think it includes like $4,000 worth of value or something like that. And the trade analyzer and all this stuff. Today's the day to do that. The next cohort will likely not be until Q4 later this year. We're going to wait. We're not going to do one next quarter. We're just going to wait till the end of the year for the next one. So if you're thinking of joining, this will be a good time to do that. And of course, like we said, episode 4 of the series, the last episode will be on Wednesday, May 28th. Block that date. Stay tuned for email updates to register for the event and submit your questions. Okay, John, let's dive right into these pre-submitted questions. And of course, I invite you, as we're talking and questions pop up for you, we invite you to put those in the question and answer portion of Zoom. Don't put them in the chat. They kind of disappear. So just make sure you put your questions in the Q&A. We'll get to those as soon as the pre-submitted questions are done. First question is by Garrett. If you have found your edge and still make repeated physiological, I think psychological errors, have you find any success for traders overcoming these errors that are holding them back, then turn to probability? What do you think, John?
I interpreted this as psychological as well. And so I'll get it out of the way early here. If you don't have a plan, if you don't have a plan that you believe in and understand, that's going to manufacture additional psychological errors. And I need to put that out front because, I think sometimes people jump the gun. So you need a plan you trust first. If you have a plan that makes sense to you, it has edge, you trust it, you understand it, and you're seeing psychological errors pop up, I'm going to tell you that pretty much most of those errors, if not all of them, are going to be related to awareness, meaning while you're trading, some emotion, some feeling, something is going to arise. It's going to cause you to do something that's outside of your plan, and then you're going to later regret it. This is the general form that most psychological errors take. Like, when you're not at the screen, when you're planning, whatever, you're in a certain sound state of mind, then you get to the screen and something hijacks that mindset and you end up making an error. So awareness is the key. Without going too far into specific protocols, I'll tell you that, in my opinion, the number one tool to gain awareness is going to be meditation or some type of mindfulness work, some type of work in that vein. It doesn't have to be related to any type of religion or anything, but some type of a mindfulness work, some type of mindfulness is your best weapon. I'll relate it to like this. A lot of people, like in the act of meditation, a lot of what you're asked to do is return your awareness to the breath. And folks think, oh, I started to meditate and my mind goes everywhere, so I'm doing it wrong. Well, no, the way it works is your mind is supposed to go wherever it goes. You bring it back to the breath. And when you bring it back to the breath, that is like a rep. That is like a bicep curl. But the muscle that you are working when you do that rep is the muscle you need to gain awareness in trading. So without going into specific errors or anything like that, that is the general formula that I believe is the only way to really help with psychological errors. It's gaining awareness. If you have some other way of doing it that's not meditation, it doesn't have to be meditation, but that's what's worked for me. But it's all going to be about gaining awareness. And the form is going to be you're in some mindset that makes sense when you plan things, you get to the screen, you lose that awareness, you regret it afterwards. And the key is going to be bringing awareness to what you're doing when you're at the screen.
Yeah, I would agree with that. I mean, the other piece is just um, psychological errors. Hopefully you're tracking those. One of the things we always do is note down what those costs, right? So one of the things we always did is, for example, if someone is repeating errors, if they track those errors, like for example, I'm supposed to take a 15-point stop and I keep taking 30-point stops. Okay, let's see what that costs over time, and you'll find that that's a shocking number. It just erodes the overall performance, but it also erodes our psychology. There are several paths here. I'm a big advocate for meditation. All my traders had to learn to meditate. I want to make sure that you can, you know, think of it this way. It's like a pendulum. Your emotions. You come in, the market's not open, and you're ready for the day and you start to get excited. So the pendulum starts shifting towards excitement. You take that first trade, it doesn't go well. It swings the other way. And the thing is, emotions are just constantly swinging, and that never goes away. Even if you're a 25-year trader like I am, emotions are always there. The thing is, the difference between feeling psychological having psychological issues and feeling emotions and acting upon those are two different things. My pendulum can swing all at once, but I will not act on those swings. So I'm still going to be loyal to my plan. There are several, there's meditation helps you do that. Meditation helps you sit, observe the noise, observe your brain coming up with fictitious scenarios or fictitious futures that won't exist, that don't exist in reality, but you're always reminded, through your meditation practice, your mantra, your breathing, whatever, that when you bring your mind back to that part, that all of that dissipates and you kind of experience firsthand through meditation that just because your mind is reacting to it doesn't make it a reality. And for most people, that experience doesn't exist. Okay. So, you can use religion, you can use yoga, you can use physical activity to dissipate that stress, whatever. Doesn't matter. Come up with something. There's also like Tendler's book is a good has a good process for identifying what you're doing in the heat of battle. There's a lot that you can do there, but you got to do it. You got to pick something and do it. That's the part that is kind of often missing. You know that it's a psychological issue, but you're not doing anything about it. And therefore, it just continues to be a problem. Next question by Emily. During intraday, I saw sweep happening in the opposite direction. Should I close and join the direction of the sweep? Asking because during scalping, I often see trade set up in both directions. So these are spikes and flushes that occur because of size. I'm guessing this person's in the NQ probably. What do you think,
Probably.
John?
Well, I don't know if you're going to say something different here, FT, but what I'll tell you is I have never, I have never in my life met or heard of a discretionary intraday futures trader who regularly reverses his position and does consistently well with it. I'm not saying he's not out there. I'm saying I haven't met him or heard of him. And I don't do it. I'm going to be real with you. Putting on risk, taking a trade, it's mentally taxing. It's a very mentally taxing thing. And to think that you can put on this trade, you put on a correct trade, it goes your way. And then in the process of that trade, you hatch the idea for another trade in the opposite direction. I don't think that that's psychologically sustainable or something that you should aim to do. Um, this is very distinct from something like you have a directional trade, right? It's structural. You build the position with multiple entries. That's a different thing. But like expecting buying the low of a rotation, selling the high of a rotation, and reversing to capture that same range again, I would not recommend that anyone tries to do that. I think that is, I don't think it's psychologically sustainable to ask yourself to do that on a daily basis, in my opinion. So, so should you close in reverse? I would say no. I would say no. I wouldn't, for me personally, I don't, like I said, I've never seen anyone do it. I do not believe it's psychologically sustainable. So I can't recommend that you pursue this in trading. That's my opinion.
I immediately, the thing that comes to mind here, Emily, is that it tells me that you may not have a proper plan in place. You don't have a process. So you're going to be subject to size being on the offer. Your long size comes into the offer. So you're going to close your long because, oh my God, that's too much for it to get through. And size is on the bid, you're long. So you're going to hold on and maybe add, and then that size disappears. And now you don't know what to do. Those are all actions that follow not having a plan. This kind of question immediately raises a red flag. If I was backing you or trading my money, you would be on liquidate only right now immediately, because it just tells me that you are trading flow. You're trading on your gut. There's zero edge to trading based on your gut, trading based on what you see. Oh, the market looks like it's running this way, especially if the product is the NQ or something thin like that. It'll drive you nuts. There's just, I'm sorry, but there's just zero edge to doing this. Now, if you are entering a trade based on a setup, I see what the trend is in my time frame. The trend is being defined this way. There was a reversal. I got long, and somebody sweeping down as the market's trying to push up. Somebody sweeping down. Should I close and reverse? No, because you're in a position that had a defined stop, I hope, and defined targets, I hope. Just because some action took place in the market does not become a new setup. You should not be entering a trade without a definable, explicable, verifiable setup, period. I should be able to ask you on any given trade that you're in, and this happens in a prop shop, I have to be able to say, what's the premise of this trade? What's the theoretical basis of this trade? This is a question that we ask a lot in the accelerator program. What is the theoretical basis? What's the basis of this trade? You better have something better than, oh, somebody swept the book down and I was long and I reversed. Like, that's just not gonna fly. That's just gambling, right? At least when you gamble, you get free drinks some places. So this is I would discourage you from doing this. It is not sustainable long term. Okay. Also, remember, futures are a hedge instrument. So somebody who is protecting profits may not want to get out of a large long position in equities. They can hedge their portfolio by selling futures, even though they're still very bullish. They're just hedging ahead of IBM earnings, Tesla earnings, whatever, and they remove that hedge later on and they give up the difference. So we don't know why that sweep happens, and so it's not a setup. Okay. Becky, question about when, if to give up on a trade in a suddenly quiet market. The fill is terrific. It's the right direction in a huge liquidity market, good signal and trading system. Then suddenly an early market that had been moving goes silent, sideways, like a boat on a quiet lake. Not taking any heat, but each attempt at breakout level, market backs away and just sits for hours, days of swing trading. Trade not taking any heat, but not moving much, except trying tying up some margin. Do you always advise stay in until market shows otherwise? What would you do, John? I know you're not a swing trader, but what would you do?
First off, I got to comment. This is a good question. I really like it, and it's written well by somebody. I get a feeling that this is a person that's kind of has a little bit of experience in this because it's a bit of a better question. That said, I'm gonna answer it two ways. I'm gonna answer it from the perspective of a newer trader, and then I'll give you a little bit more from someone who might be a bit further along. Now, for a newer trader, the answer is to stick to your plan always. You should have a plan for where you're entering, where you're exiting, why you're getting in the trade. And when you're newer and you're working out profitability, you should not change those things. Even, you know, things don't work all the time, but also this is really big. Seeing when your setups don't work and how they don't work is a part of learning. It's a part of understanding your setups. So before you know that setup too well, or before you really know what you're doing and you're newer, you just need to stick to your plan to a T, and you need to have a plan in place. Asking yourself to make subjective choices while you're in it, qualitative judgments while you're in a trade it does not work. It does not work. And when you're newer, it especially doesn't work. Now, as I said, this question kind of has a feel like it's written from someone that has a little bit more experience under their belt. So I'll give a little bit more of a nuanced answer, which might help this person. Now, it's kind of the same to begin. You still don't want to ask yourself to be making too many choices. But that said, I'll tell you an example. Today in the S&P 500 was a wonderful example of, I believe, what this trader is talking about. If anybody's watched my plans today or watched my plans over the course of the past week or so, I've been talking about how the long trade in certain environments starts to lose risk reward. It starts to become very obvious and lose risk reward. Today, buying DGPs after that initial impulse and looking to sell the high of day or near it became a very crowded trade. So this could be one where you take the trade at the DGPs. I did it. I was in on this. And then you're looking to target the high. But what happens? Look at that chart. Everybody is buying DGPs. Everybody's buying it. And what does everybody want to sell? The high. And look how hard it gets. Really easy to buy DGPs and really hard to sell the high. So for me, there are certain situations, and this is a very specific one, where I know my target is the high. But if I can get 2R, if I get 2R ahead of the high, that's in my plan for that to be a successful trade. And that's how I managed that trade this morning. I saw what was going on. I saw that it was super crowded at the high. I posted in CT about how every local in the world is trying to sell the IB high. And so for me, I didn't have to wait for those extra, 3 points to make a trade. I already had better than 2R. I closed my trade. And so for someone that's a little bit more experienced, you might be able to kind of see those situations happen where a trade gets crowded and where a certain target gets to be very hard to execute at. And for me, the way that I do it, as someone that's been doing this for a long time, when I see a crowded area that I'm targeting, then I am looking more to capture the RR that is required for my plan, rather than try to sell the price everybody's trying to sell. In this environment today, I was using a 4-point stop in the ES. So I get 8 points of MFE, 12 points of MFE. That is what my plan calls for. That's good enough. I'll leave a runner on in case the whole crowd is right, which they sometimes are, which is what I was kind of alluding to in Convergent this morning. I was like, hey, look, locals are buying DGPs and we want to see what happens at the IB high. We're hoping paper keeps buying. And if they do, great. But if they don't, then our longs aren't going to work. So that's kind of two ways to answer that. If you're newer, you need to have a plan that outlines what you do, and you need to just stick to that plan and forget about it. If you're much more experienced, you may be able to have a more nuanced answer to this, but it's not that nuanced because for me, I'm really just following my plan according to the RR that my trade needs. Rather than looking to sell the high, I'm willing to exit my trade at 2 or 3R, which still counts as a valid trade for me. It's in my plan. So that's my answer for newer folks and a little bit more nuanced. Hopefully, I didn't go too long on that. If I did, sorry, FT.
Yeah, I mean, it's just Becky, it's really there is such thing as a time stop, right? I used to use time stops. I don't like being a sitting duck, and the determinant for that is, did I get enough scale outs? You know, if I enter with, say, a 6 lot ES, did I get enough cover on, say, 2 contracts with enough difference to cover all or the majority of my risk? If so, and I see that we're breaking from balance and it just keeps coming back and it's just slow and it's drying up, those kinds of circumstances actually create a really good opportunity for it to pop. Eventually one side is likely to be wrong. You know, in our view, balance leads to imbalance, which leads to balance, and so on. That's the market's job. If my risk is covered, the trade parameters have not been violated. But I'll tell you, if I get in, like John's example here, let's say my first exit's just beyond those tops that just held steady, and I'm not getting cover, and it just keeps coming back, and I'm sitting here for, a half hour, an hour, or something like that. That's just I'm not hanging out for this. It's something where I'm going to go and close the trade. It's really a function of why you got in, and if anything has been violated enough to deter you from taking that trade again, if you could, right? So that's, you have to measure it against. Always measure what you're going to do against your plan. I do futures day trading like NQ, and I trade like two out of three trade 2 to 3 trades per day. I'm planning to apply scale out, but I'm not sure what's a good guide to do scale out, since I only do all in, all out for most of my trades. Mike, what do you suggest here, John?
Well, I can't really give you a specific protocol because I don't know I don't know anything about how you trade or there's people in the NQ that scalp for 1R. There are people that look for significantly more than that. I have no idea how you trade, so I can't give you something specific. What I can tell you, and also the key is we go deeply into this in the accelerator program as well. So we do go, we do all that in the program. I can't do that on this webinar. But I'll tell you what I do in terms of scaling, the way that I scale. For me, I'm generally looking to make 2 to 3 R on my entire trade. I have 3 scales that I look for. The first scale is typically at about 1 or 2 R, and the point of that scale is to take the risk off the table. Once I get filled on that, the risk on the entire trade either goes to zero or very close to it. That's the purpose of that initial target. The second target is the one that creates revenue. When I get that one, that means the trade is profitable no matter what happens on the rest. That's usually at like 2 or 3 R. The last one is a runner. And so if I have a structural or a statistical target, I'll hold for that structural or statistical target. If I don't have one or it's not really feasible based on what's going on, then I'm usually aggressively entering that or aggressively exiting that last one anywhere above 3 or 4 R. So the first scale, 1 to 2 R, pays for everything. Second scale, 2 or 3 R, rings the register. And then if I have a structural target, the last one goes to that. But if I don't, I'm going to aggressively be out because the trade's pretty much over. And I've already gotten 3 R, and I don't have a structural target. So if I'm getting 3R and I have no further target, that's good enough for a day trade, in my opinion. That's how I do it. I can't be specific with you without knowing more, but that's how I do it.
Yeah, this is really a function of how you look at the market. Like if you're entering based on a moving average crossover, then the question becomes, um, how often does the market initially move in your direction, so you can scale. Like the most important thing, like John just covered, and we cover all the time, is we want to protect our risk. We want to create an asymmetric risk situation. So for me, I'll tell you, for me, it's based on rotations. I'm looking at harmonic rotations, which we publish every week, every Sunday, and we use that information um, to inform how wide our stops need to be, how wide our first scale out needs to be, and so on. And the idea is once we get that first scale, then it's basically just following structure, looking at, okay, the market tested down, let's look at a chart real quick. Like you look at crude today, crude pulled back. We open up, we had a pretty decent drop in crude overnight. Then we pull back to basically where we spent most of the overnight session is before the drop. And then it finally clears DGPs and it falls through. And now we've got a double bottom here. There's the bottom of today, this morning, RTH, and the bottom of yesterday, RTH. Both of those are 62.93. As soon as it breaches that, pulls back, okay, that's my trigger for a continuation trade. This is a continuation trade here. And I'm looking for it to now get the next statistical probability, which is the overnight stat, which is the overnight low, 62.64. So I have approximately 30 cents covered. Cover my 30 cents. The harmonic right now is like 36 cents or something. Gives me the 30 cents. My trade is almost risk-free at this point, and now I'm trading level to level, right? So I get the overnight low. I look at the next stock zone. The next stock zone is at 62.45. The next one is down here at 61.75, and so on and so forth. If I can get those, that's a payday. If the market gives me a scale and comes all the way back and starts to trigger a stop, that's a trade that didn't work. So that's how we're managing. We're managing it based on our understanding of rotations and our understanding of the structure that the market is doing. And all of it is backed by what is the market trying to do and how good of a job is it doing. In other words, if it tested into the overnight DGPs, this full session VWAP, full session mid, the structure over here, if it tests and it fails from there, I don't really have a trigger for a trade until the IB gets taken, but still, it tried and tried and tried and couldn't hold those prices. Chances are now it's likely to explore the other side, which is the low after the open. And then beyond that, it's the low in the overnight session. So that's how we're managing scale outs and risk, okay? Alan, I was trading 3 lots ES before this month. Now I have to trade 1 lot due to the heightened volatility, but having some trouble managing my exits. What do you recommend on trading 1 lot to manage taking profit? I know what John's going to say to this. Moving to break even after 1/3 of my target, etc. So Alan's already doing what we advocate. Really trying to avoid trading 10 lots MES, due to all the slippage and extra commissions. John, what would you do here?
Okay, so first of all, with the volatility expanding in the S&Ps, I've had to adjust how I manage trades. This is I've talked about this a lot in at CT and trade talks and whatnot. I've pretty much had to double my stops and cut size. So that's what I've done. And once I've done that, instead of looking at a 1/8 PNF chart, I'm generally looking at a 2/10. Making those changes, everything's pretty much the same from where I'm standing, except it's busier. So those are the adjustments I've made. And after making those adjustments, it's once again a familiar environment. In terms of one ES versus 10 MES. So we get this question every once in a while, and so I'll give you my firm take on this. If you're a discretionary trader in the futures market, you're limiting your ability to manage risk and reward trading one ES, in my opinion. I don't see a reason to not go to the MES. Scaling out is a psychological edge. The ability to take partial profits helps your mindset. And if you are discretionary, your mindset is really your ultimate edge. The MES does have higher commissions, but they're worth it. They're simply the price you pay for the ability to mitigate that risk and to take those scales. and it's worth it. It's 100% worth it. Slippage in the MES on 10 is not a legitimate concern. The MES is actually very liquid, and you'll be fine trading a 10 lot in the MES. It's no problem at all. So those are the adjustments that I made for my own trading in the ES. And for you, if you're going from 3 ES down to 1 ES, it needs to be 10 MES. That's really my feeling, and I'm pretty firm on that one. I don't see a good argument the other way. I understand the question with commissions. They do more, they are more, but you get an advantage. You get an advantage, and you just have to pay a little bit more for it. So that's my opinion on it. What do you think, FT?
That's exactly the point. Yes, the MES per 10 lot is more expensive, right? So make sure your broker is reflecting the additional volume that you're doing. You should be able to trade them, for 22 cents or whatever, plus exchange fees. Um, you should be able to get a decent rate, but the 10 lots versus what you're paying for the ES, the delta between those, a lot of that is, well, it goes to the exchange, but a lot of that is the advantage that you will get. The asymmetric risk reward is what we're after. It's the advantage of being able to be more flexible with your risk management. It's well worth, I mean, think of it like a businessman. It's well worth the cost. It's kind of like, do I want to self-insure and hope nothing happens? And if it does, then I might be broke, or do I just pay for insurance and get the convenience of just having someone else carry that burden for me? It's that kind of a decision. So to me, Alan, it's a bit of a no-brainer. It is, if 3 lots are not possible anymore, and I'm going to tell you that I always say I'm a terrible 1 lot trader. I have no idea. I truly have no idea how anyone can be all in, all out trading anything. Like, I would not be able to perform with a 1 lot. It's, for me, the scale out process creates so many different opportunities, especially later on when you advance into scaling out and then adding back in campaigning into a position, scaling out of that for more cover, risk cover, and so on. To be able to play with more than a single lot is quite important. It's well worth it. And hey, just do it for a period of time when, the volatility is too high, and then fall back to your 3 ES, 3 lot ES, which I don't think you'll see the 3 lot ES probably till sometime in the summer doldrums. I don't think the volatility is going away because we have an administration that loves surprises. It loves the drama factor. So it's the news is going to keep flowing, and we're going to keep getting volatility. DeWitt is asking, how important is the size of your account in trading? It's not talked about much, but I think it's a key to success or not. What can you say around account sizes for the MAS trader and the ES trader?
Well, account size is important. It definitely is important. You need to have enough money in your account. Um, but the real thing that you're asking about is the psychology of it. Too small of an account, you're going to be scared money can't win. That's one of those adages that actually is true. So if your account is so small that you're fearful of losing it, or it's money that you need, then you have an obstacle that isn't even related to the ups and downs in the market, and it's really one to contend with. This is a difficult question because if you don't have if you can't fund an account, there's nothing I can say that solves that problem for you. But that being said, you need to have an account that is sufficient, that gives you a long enough runway. Now, here's something additional I'll tell you. I would recommend with micros, you can really do a lot with very small accounts. I mean, the fact that you can go into the market with 5 grand and you can operate in the S&Ps or MES as if it's a $50,000 account and have it mean something, that's insane advantage to what wasn't here, prior to 2019 or whenever the MES showed up. Um, But that being said, something that you need to have if this is an issue for you is you need to have lines in the sand. Meaning you need to have a risk. Well, you need a plan, of course. That's what part of what we harp on. But you also need a risk plan. And part of that risk plan should include what happens if your account gets drawn down to a certain level that, what is the level that you pause? Like if you draw down 30% of your account, there needs to be a pause. Or if you draw down beyond 50, you need to stop and step back and figure out what's wrong. And building in these breaks, these contingency plans for if and when things go wrong will help psychologically insulate you from fear of them happening. Because if they happen, you have a plan. That's really the best. That's really just about all you can do. And it's really the same as what we do as traders every single day, or what we should be doing, which is just going through the motions of our plan. That's all we should be doing every day. And so when you have a plan, when you have a small account that you're trading, and you have a plan for what happens when it gets drawn down, this gives you, a course of action that lets you stay on the right side of things when, even if your account is drawn down. So to answer your original question, how important is it? Does it make or break your chances? It can. I mean, it can. If you're telling me that you have $900 and you're trying to trade the S&Ps, that won't work. But if you have, with the micros, you can really go very far with as little as 2,500 or 5 grand. You can really do a lot of learning if you have a plan and you use that account wisely. If you just go into the market with a small account and just take your chances, then you're just going to waste your money. But that's all I got for that one.
In general, my advice, if you want to be well funded, my advice is to put in the full exchange margin per contract. Hey, I'm a 3-lot ES trader. Let me look at what that is. I'll show you. I'm a 3-lot ES trader. Okay, initial margin's 23 grand. I need $70,000, basically. I need $70,000 to trade that 3-lot. Intraday margin, it doesn't mean you should be swing trading and holding through the close and so on and so forth. But it's what you're doing is you're funding with the full initial margin, which is based on risk and volatility. So right there, it's the exchange changes these margin requirements based on risk requirements. That's what margin is. It's not a cost, it's escrow. It's escrow. It is money that's held and returned to you when you close the position. And then your losses are taken away from that. And so for the ES, that's really what's recommended. Full margin per lot. That answers your ES and MES. So MES, same thing, 3-lot MES trader, put in 7 grand, right? However, there are brokers out there that will tell you that they have $50 per MES margins. I think that's absolutely insane that a $900 account like John was just talking about can get you into an 18 lot in the MES. That's nuts for $900. Of course, they'll blow you out at $200 and charge you fees, but it's great for the broker, but it's not great for you. So don't use that kind of leverage. It's not smart to use that kind of leverage. So at an absolute minimum, you want to be at 50%. Now remember, you're funding that amount, and then your costs for your data feed, your losses, and so on have to be debited from that amount. So you want it to be full margin. I know most people can't do that. At a minimum, it's 50%. Count on 50%. That's what I would consider to be prudent. And then you get into the situation with that John talked about, which is, what happens when you draw it down 25% or 50%, so on and so forth. You do not want to trade with too little money or too much leverage. Those two situations are equally perilous. It creates additional anxiety. Your P&L becomes very important. You're starting to watch every dime, and now you've lost the plot. You're no longer trading the market. You're just trading your P&L, and that's a losing proposition. You might get pops here and there, good runs, some luck, but as a professional trader, which I hope everybody here is looking to do, to become a career trader, this is not the way to go. Joe L., we're almost out of time. What would be the number one thing a retailer could improve on to improve their win percentage?
So if you're asking that, I'm assuming that you already have a trading plan. I'm assuming you already have a risk plan. I'm assuming you already trust your setups, and I'm assuming you show up mentally prepared for the most part every day or as best you can. And I'm assuming that you have a basic grasp of all of your psychological issues. So assuming that you have all those things in place and you're looking to improve your win percentage, the answer is going to be in your journal. The answer is going to be staring right back at you in your journal. I actually just did a study hall on a similar subject matter for CT. So if you remember, you can check it out. But what I would recommend, all if you have all those things in place, then you look into your journal. And what you need to look at, if it's not a plan issue, like if your win percentage isn't a plan issue, it likely isn't, then you need to look at what are the behavioral goals you could set. We call them process goals. Oops. Oh, sorry. Uh,
Floor trader problems.
oh,
You're talking to us from a space capsule
am
now?
I still on?
Yeah, we see you in a different camera. It's up to your left. It's up high.
Oh, okay. There we go. All right.
Nice
Sorry.
directional awareness.
My camera. Okay.
Blurred.
Sorry about that. My camera went haywire. But anyway, where was I? So the answer would be in your journal. And what you have to look at is you have to look at what process goals which modulate behavior. What behaviors could you institute that would be supportive of this higher win percentage? And so for that, you have to look into your journal and say what's keeping your win percentage down. So we're running out of time. I'll give you one of the examples I have. Say your win percentage is held down because you double down on losses, meaning you take a stop and then you end up re-entering that trade quickly. That's a common issue. If that is your issue, then one process goal you could create, which is a behavior that would support this goal, one process goal you could create is to have a checklist that you can go through after you get flat every single time. And that's a behavior that doesn't in itself create a higher win percentage. But if your problem is doubling down on trades, this is a behavior that could then become a process goal. And if you successfully carry out this behavior, it will be supportive of this outcome goal to increase your win percentage. And it is in this way that we can improve our trading outcomes. We can't improve the outcomes directly. We have to create process goals to modulate our behavior. And then when we carry out that behavior, the idea is that will be supportive of the outcome goals and we'll eventually see those outcome goals hit. That's the process. We have to create a feedback loop. So that's my advice for you. If all of those things are in place that I mentioned, then you need to look into your journal and you need to figure out what behaviors can you turn into process goals that could support your outcome, your desired outcome. That's what I got for you.
My immediate response to this is, why is win percentage important? Because there are some amazing traders out there that are at 25, 30%. I don't know why win percentage has any value. Expectancy does, but win percentage, you're winning 99% of your trades, but the win is one tick. Your losses are 100 points apiece. That's a very, very negative expectancy. It's a destroyer of accounts. Don't go for win percentage. It's too high level to matter. What you want to look for is expectancy. Expectancy is what tells me, or expected value. You can look that up. You can go to convergenttrading.com to the glossary and look up expectancy. We tell you what that is in there. You want to pay attention to expectancy because it looks at the percent win as well as the size or amount of that win that matters, minus the percent loss and the size of those losses. So, if you're, people say, well, if you're less than 50% on your win percentage, then there's no way you could be making money. at 50%, I just need 1.3 R or better, or 1.3 risk reward or better to be profitable. That's not very hard to achieve. So I would suggest to you to not worry about the win percent and look at expectancy as a measure. But what John said is very true. You know, create process-based goals and figure out how to achieve those and make them something that's a stretch goal but is achievable. Over the last few years, I've failed many evals and developed a strong trading addiction. I'm trying to overcome my bad habits. I haven't traded for over a month now. How do I resume trading? What pitfalls to watch for avoiding the same errors? This is Rusker, friend Rusker. Glad you've taken a month off. What a great month to take off, because it's just been a mishmash of crap in there. Some pretty good opportunities, but it's very, very whippy and it's very emotional. It's a very emotional type of trade right now. What would you say to this? How does one who had bad habits and stopped for a month, how does this person resume? What do you think?
Well, the first thing you have to understand is that you have to do something radically different than what you've done before. And I don't say this lightly. I mean, here's the thing. I mean, you mentioned Rusker, and I know you well, love you, buddy. You mentioned addiction, and here's the problem. You're right. It can become an addiction, and not just any addiction, but this addiction can become the worst one. The worst, worse than booze, worse than drugs. And I'll tell you why. Because you might buy an evaluation account this month and you might get a payout. That might happen. You might get a big payout. I can't tell you it's not going to happen. You could go and carry out all your bad habits and it could happen. That's a true thing. And that hope is toxic when you aren't doing the right things. It's toxic. And you need to be aware of that, because that's why gambling is the most toxic addiction, because there's a possibility of it actually working out and that hope kills you. So what you need to do, Rusker, you need to get away at least a month. And what I would recommend when you come back, if you're doing the evaluation fund, that route, if you're doing that, you need to buy one a month. And then you need to have a plan. You need to have a completely structured plan that actually does all the things we say. And you've been a member for a long time, so you understand all of this. And you need to, what I would recommend, one evaluation account per month. You trade that until you either pass it or you fail. If you fail in the first week, you're done for that month. And that way you can at least, you can take a break, you can slow things down, and you can actually iterate month over month. Like you last 3 weeks with this account and you were up the first 2 weeks and then it disappeared the final week. Well, okay, now you have something that can be a starting point for the next month. And in that way, you can start to iterate rather than just buying account after account after account and being in this crazy gambling mode where every day something good might happen, but really mostly bad stuff's happening every day. So that would be my recommendation for you. And I really hope that you give consideration to it, because you need to take a break. And when you come back, you need to slow down and it needs to feel different than whatever it feels now, because the feeling you have now when you get in front of the screen is not one that's getting you to your goals. So make no bones about that. That's all I got for you, buddy.
I agree there. Okay, we'll move on since we're out of time here. Do you think the news flow out of the White House has hints of market manipulation, Lucas?
You'll love this answer. No comment.
I'll
Here's a
tell
simple
you.
one. Well,
Yeah,
I'll just say, so do leaders say things to prop up markets sometimes? Yes. Do leaders know that their rhetoric influences markets? Yes. That's all I'll say.
there you go. Wow, you really should be running for office over there in Pittsburgh, bro. That's a very diplomatic answer. My answer is hell yes. Hell yes. There's definitely a lot of that going on. And by the way, it goes on from both sides. More blatant from the current administration, but let's not forget about Nancy Pelosi and her NVIDIA trades. You know, money's money. You know, if unless there's a law and um, there's a criminal justice system that enforces that law, then they'll do what they do. When your sit out days or vacation, when your sit out days or vacation, do markets realizations still come up for you? Do you jot them down, let them simmer, just let them pass? I'm now taking breaks more often, but feel like I should be doing a little more, hoping to incorporate more balance in my career. This is tunnel vision.
Tunnel vision, I know you pretty well. I know that you're a guy that's very structured. You're a very reflective guy. You keep a great journal. And so if you are taking time off, because I know how much you put into this, if you are taking time off, my answer for you is I would keep whatever you're doing that's market related during your days off or your time off, keep it a little lighter. Like you don't pour over spreadsheets, do something like read reminiscences of a stock operator, something that's market related. There is value to it, but it's fun to do. So that's what I would recommend for your kind of time off. Keep it light if you're doing market stuff, enjoyable things, inspirational things, unless you have some specific area of improvement that you need to buckle down with. If that's the case, then you go into that. But if you're taking time off, keep it light. And I would actually recommend that you look a little bit more into stuff like personal development, a little time away from the market, maybe some exercise, meditation, unplugged time, just journaling non-market thoughts, because personal development is going to help you as a trader. And also that time away from the market, it's going to calm down your nervous system and make you and help you be better equipped when you get back in the mix. Because the market, it raises all of our arousal to a point. And so when we step back, it needs to calm down. So if you're stepping back, I don't want to see you getting too neurotic over how you can improve. Allow that be the time where the improvement is recuperation. So that then you're more receptive to your learning and to what the market has to offer when you come back. That's my advice for you because I know you and it's specific to you. So I hope it helps out, buddy.
Okay, so I don't have anything to add to that. A couple questions that came in the Q&A box by BG. Do you ever add to a losing position? If yes, how many times? You have 1 minute.
No, I never add to a losing position. I'll occasionally have more than one entry on a position, but I'm never adding to a loser that goes beyond where I thought it would. So the answer is no, never.
Yeah, why would you multiply a loser, right? Um, in reference to stop placement, due to the heightened volatility, if, for example, your normal stop placement's 50 to 60% of a full harmonic rotation, have you guys kept clip size constant or expanded stops, or have you solely sized down?
No, just like I answered before, I essentially doubled my stops and cut my size in half. That's that, and since I've cut and the market feels very familiar in doing that. And I in the first like week or so when things kind of opened up, it real like I had a tough time with it. I was switched over to crude. But I made that adjustment. My stops are twice as wide for the most part. My targets are twice as far, and my size is about half as much. And I'm using slightly different P and F charts, and that adjustment feels normal again. So that's where I'm at.
You have to do both because if you widen your stops without cutting your size, you're risking a higher percent of your account per trade. So it has to be a combination of both. Okay. That's about it. That's all we had. It was a pleasure doing this. We'll catch you on there it is. We'll catch you on May 28th. A reminder, tonight is the last night to be a part of the accelerator program, the current cohort. We're not doing another one till the end of the year. And then otherwise, we'll catch you in episode 4. Bring your questions on, challenge us, let us know what's going on in your trading, and we'll do our best to help you out. Thank you, John, for answering those questions. Thank you all for being here. We'll catch you next time. Take care.
Thanks, everybody. Bye bye.